All right, we are back with more housing market data that suggests that home prices have remained more resilient than I think many of us have thought, and they may remain very resilient and strong going into 2024. So we have two articles here for you today. One is out of Calculated Risk. It reviews the Case-Shiller data, and then the second is going to be the Redfin Weekly Housing Market Update. You're not going to want to miss that, but before we jump into it, if you wouldn't mind, press that like button, consider subscribing. It helps grow and promote the channel, and I appreciate your support. All right, let's jump right into it here. We have the Case-Shiller Index. This is the month-over-month seasonally adjusted numbers, okay? So monthly home prices for October, they're actually up 0.65% month on month. This comes as 9 straight monthly increases in a row, and that was followed by 7 straight monthly decreases. So home prices have actually gone up. They remain resilient like we mentioned. Now, this October data here is actually a 3-month average of August, September, and October's closing prices. It's important to keep in mind that October's closing prices include some contracts that were actually signed back in June. So there is a significant lag to this data, and with the volatility we've seen in mortgage rates, some of this is likely to change going into the future. Now, according to this data here, U.S. home prices have actually accelerated at their fastest rate of the year in October. They're up 4.8% annually. Now, this is on a national level, but if we break it down to the composite 20, so this is 20 major cities, 19 out of 20 of these cities actually saw an increase on a month-to-month basis. The only city that saw price declines was actually Portland, Oregon. On a seasonally adjusted basis, there are a few markets that still are down. San Francisco has fallen 8.1% from the peak. Seattle's down 6.5%. Portland's down 4.3%. Las Vegas is down 4.2%, and Phoenix is down 3.9%. But of course, the overwhelming majority of markets throughout the country have actually seen prices start to come back up in 2023. Now, for those out there that may be thinking, once we get a wave of foreclosures, we're going to start to see home prices come down substantially. Well, that may not be the case here. The data suggests the exact opposite is taking place right now. This chart is single-family serious delinquency rates. It's anybody that's past due 90 days or greater or in foreclosure. Well, according to Fannie Mae and Freddie Mac, we're sitting at about 0.54% of all borrowers are seriously delinquent. That's well under 1%. And if you go back and look throughout history here, even when we had the big wave of foreclosures during the GFC going into 08, 09, and 2010, those delinquency rates were over 4%. You know, Freddie Mac was coming in at maybe 4.2% roughly, and Fannie Mae delinquency rates were right at about 5.5%, roughly 10 times greater delinquency than where we are today. And the loans overall today, we're talking primarily 30-year fixed rate debt. Rates, I think 90% of all loans are under 6%. So I believe that homeowners in general are going to be fighting to stay in those properties, because what is the alternative? If they have to lose the home to foreclosure, they have to go back out and rent. And in many cases, some of these areas, it would be more expensive to rent than it would be to actually own with regards to the monthly mortgage payment, not necessarily operating the property, but the mortgage payment in some cases is going to be cheaper than what the rental rates are today. On the topic of affordability, mortgage rates have dropped here as well. This is the 10-year Treasury yield. The October highs here were just touching about 5%. Now we're already down below 4%. We're actually at about 3.79% at the time of this recording. Mortgage rates are closely tied to the 10-year Treasury yield. They generally tend to follow this yield in lockstep fashion. So when the yield goes up, mortgage rates go up. When the yield goes down, rates go down. That puts the average 30-year fixed rate today at about 6.61%. That's for a conventional loan for a very well-qualified buyer. But the government products here as well, FHA, VA, they're hovering right at about 6%. In some cases, you can even get into the 5s with these mortgage products. And with the lower mortgage rates comes a lower monthly payment. According to Redfin, the median U.S. monthly mortgage payment is now hovering at about $24.72. That's down by about $264 a month from the peak that we saw in October, when rates were at about 8%. But it is important to note that this is still up about 11% year on year. So housing is still certainly less affordable than it was a year ago, and it's far less affordable than where we were just a few short years ago. Purchase applications are up about 3.5% week on week, but year on year, they're still down about 18%. And if you go back and look at this chart over the last decade, you can see we're pretty much sitting at the lowest level we've been in many, many years. Refinance applications, this is an interesting shift here. Week on week, we're up almost 20%. Year over year, it's up about 27%. And that probably has to do with the recent reduction in mortgage rates that we've seen. And those folks, potential home buyers that bought maybe 6, 8, 9, 12 months ago, and their rates were, let's say, north of 7%, maybe even touching 8%, depending on the timing. And now they're in a position with lower mortgage rates. They can potentially reduce the rate, lower their monthly payment, put them in a little bit better spot. That's probably what's taking place right here. If rates remain steady, we'll see this number probably hold pretty strong. Now, the early stage demand we're seeing here has not necessarily translated into contracts just yet. According to Redfin, you can see that pending home sales are down about 7% year on year, but it is worth noting that holidays are typically a slow season for the housing market, and you can see that even in prior years, it basically followed the same trajectory here. Now, some good news here for the potential home buyers out there is that you're going to start seeing more homes to choose from. New listings are actually up about 9.4% year on year. And according to Redfin, they're starting to see more home sellers contact real estate agents to get their homes listed. And they believe that this is partially due to the reduction in mortgage rates. Homeowners are feeling less locked in by the rates that they have in the 3 and 4% range. And you can see here that we're now sitting at about 4 months worth of inventory. It's the highest level that we've been in the last few years. This basically means that if nothing else hit the market for sale, it would take 4 months to sell every single home available. This is a positive sign. It just means there's going to be more options. There's going to be more properties to choose from. And if this remains steady going into the new year, maybe even increases, perhaps there's going to be some opportunities to get some better deals out there for the home buyer. All right, and that is going to wrap up today's video. If you got something out of this, press that like button, consider subscribing. It helps grow and promote the channel, and I appreciate your support. Take care.